So property tax is going through one of the biggest changes we've seen in years. Rachel Reeves is changing rules for landlords, investors and homeowners throughout the UK. But here's the thing most people are missing. These changes mostly affect property prices that are quite high. If you're buying on the lower end, you're not too affected, and here's why. So let's break down a reform without all the noise, right? So the government actually wants to move away from stamp duty and actually move on towards taxing based upon the property value. So here's three big ideas, and I've written them down precisely to make sure we get this correct for your benefit. So number one, higher value homes may face new annual levies, or levies, however you want to say it. These actually target properties around the £1 million mark and even could actually affect anything 500k or more. So that's one thing to note, so higher value properties. Number two, council tax could be completely revalued, meaning that currently property prices for council tax are based upon figures from 1991, which is outdated and makes no sense. So modern revaluation could mean higher value homes pay more and lower value homes naturally pay less. And number three, stamp duty could be partially or completely reformed or replaced, meaning that instead of paying a big fee when you buy, the government could look at proportional taxes, meaning you pay based upon the value either annually or when you sell. Very important distinction. So who does this affect more? Clearly this affects more higher value homeowners and investors who have higher value properties. Whether you buy in London, South East, whatever it is, higher value properties of 500k or more are going to be significantly affected. If you've got property values over £1 million, that's going to be substantially more. So the irony is, I'm sure a lot of investors who buy property values of 200k or more, 500k or more, £1 million or more, they're expecting appreciation and growth factors. However, because of the taxes, it may no longer be as profitable as it once was. But here's where it gets really interesting. These tax changes and general changes don't affect so much the lower end of the market. What do I mean by lower end? I mean property prices in South Wales, North East, North West, where property prices range around about £100,000 to £200,000 maximum. These lower end of the markets have much higher yield, and yet for the tax efficiency, they're actually much less affected. So just imagine you've got a property that's worth 200k or less. You kind of fall outside the risk bracket of this whole introduction, meaning there's four main things to point out. There's no annual levies if you've got a property that's worth 200k or less. You're not anywhere near the higher council tax bands because of the new introductions, and you avoid any proportional value-based taxation. Very important to note. And the yield stays strong because you're buying low. So low value properties have high yield and therefore have high rental, therefore high yields and high cash flow. Very important to note. So just to summarize those points, the safest place to invest is in the lower value areas. And when I say lower value, again, I don't mean bad areas, I mean just cheaper areas where you've got South Wales, you've got Liverpool, you've got Northeast, etc., like Leeds, for example, where property prices are much cheaper and therefore rents are higher and therefore cash flow and yield is much higher. And the conclusion to this is, at the end of the day, if you've got higher taxes on higher property values, people will move. The really smart investors that we work with tend to adapt and overcome to the market. And if you've got property prices of 200k, 500k, £1 million or more increasing in taxes and becoming less profitable net per annum, then you're going to move the area. You're going to go to more tax efficient areas. You're going to get into high yielding areas that have better appreciation, etc., etc., etc. And a really cheesy way to phrase this is when the top market becomes tighter, the bottom market becomes more desirable. And that's the fact. If you've got less profit on a higher value property, less appreciation and higher taxes, you're naturally going to sway towards areas that have lower buy-ins. If you've got a budget of 500k there, you can buy 5 properties down there that have higher cash flow and better appreciation and less taxes than you would over here where you've got property prices 500k or more, where you've got higher taxes, less cash flow and worse appreciation factors. So here's 3 things that I would do moving forward. I would focus more on cash flow than appreciation. Appreciation will happen regardless because of supply and demand. There's only so many houses in the UK and there's more people, growing population. Supply and demand will increase prices in terms of the property of appreciation. However, cash flow is going to be your main thing. So focus more on the cash flow side, factoring in the new tax laws, of course. Be sure to stress test your deals to make sure it still cash flows, to make sure the numbers still work, even if you're below 200k. Very important to note that as well. And if you're investing this year, next year, in 2027, over the next 3 to 5 years, I'd highly recommend adjusting to the market. If you lean towards price ranges that are in the better financial position in terms of taxes moving forward, for example, 200k or less, you're going to have a much better long-term business that's going to cash flow you when you're building a property portfolio than you would otherwise. So adjust to the market, don't be afraid of it. And just as a conclusion to this video, the smartest investors I work with, again, really adjust to the markets. That when people are afraid, they see opportunity. It's something I hear time and time again. I heard it from Warren Buffett, and it's so true. When people get scared, there's opportunity. And a lot of people are seeing these tax changes as a negative. However, the smart people adjust and overcome them. to see, okay, what's the issue? Okay, if higher property values are being taxed higher, then let's adjust and go to lower value ones where the cash flow is actually better, appreciation is actually better, and you can scale better, more aggressively. So just to be aware of everything that's going on, adjust to the market, don't be afraid of it. And if this helped you at all, be sure to subscribe and like the channel, it really helps us a lot. And if you've got any recommendations for stuff you want on our channel, on our videos, comment your recommendations below and we'll be in touch.